Welcome back, ladies and gentlemen. Thank you all for joining me today. Today we're going to be taking a look at my portfolio, where I'm at, what I have, and what I'm doing. So my goal with this is that I want to be able to show you and walk you through what I'm doing, what my moves are, what my losses are, my gains are, those kinds of things, and be able to show you my process and just sort of what I'm learning. Because again, at the end of the day, that's what I'm trying to do. I'm trying to show you what I'm learning, trying to basically showcase what I'm doing from the perspective of someone who's just getting into it. So that's my whole goal with all this. I'm still learning. I'm still new. Don't follow anything that I do just because I'm doing it. All that good stuff. I'm not a financial advisor. Obviously, I'm just some random person on the internet who has a degree in finance that likes to invest and likes and thinks it's all interesting. So with that being said, let's dive right into it. So I'm creating a dashboard right now. I'm working on creating a dashboard, and some of the things I still need to update, but the important things is right here on the left, you see my net deposits and my current account value. So the net deposits, that's going to be the cash that I put in to the accounts. That's the total cash that I've put in, as well as the account value is what it's at today. So obviously we're at a loss. If you look at the top right where it says total return, that is basically just the account value divided by the net deposit, because that's really my important thing, is what is the account worth versus what I have put in. So obviously we've lost a couple $1,000s. You can ignore for now, ignore this unrealized and realized gains, as well as down here. The current portfolio return and all that stuff isn't 100% correct. I just really wanted to show you this account value. So 19,000 versus the net deposits 21,000. That's the most important thing to me right now. I'll update these returns going into the next month. I found this dashboard and I'm new to it, so I'm trying to update everything. But as you can see here, my breakdown, so I have 11% financial services, 16% technology, 18% communication services, and I have a lot of cash, and you'll see that here in a second. So you can see sort of my positions, the breakout, and I'll go through this for each one. So this is just my Fidelity portfolio. I don't have any other portfolios. Everything else, I mean, I have like a Moomoo, Webull, Robinhood, those kinds of things, but I really just have those accounts because I wanted the deposit bonus. But that being said, this is my, this is my actual investment account. So first things first, the SPACs. So this is my cash. This is just the core position that they use, so you can get a little bit of interest, but it's really nothing. But I have $9,900 sitting there. 3,000 of that is being held for a put, so you'll see that here in a second. But I probably have way more cash than I really want to have, but I'm looking for positions to add into the portfolio and things to sort of, see if I find anything good, I'll keep adding. But right now I've just been adding cash and just buying my current positions every once in a while. So my biggest position, my largest position in the portfolio is Meta Platforms, and that's going to come in at a 17%. Next is Intel, then you got Dropbox, JP Morgan, Berkshire Hathaway, Corsair Gaming, WBD, so that's the Warner Brothers Discovery merger, and then I have two puts, and I'm going to go through each one and kind of explain my thoughts on each one and where I think it's all going. But over here you can see the current value. So obviously at the bottom it says 18,904. So you're wondering, Josh, why does it say 18,904? And over here it said 19,000. Well, when you sell a put, it shows up as a negative based on whatever the current value is. So really, I'm ignoring the put for now until I get the positions, or if I don't get put the positions. But so my account value is really 19, not 1894. Anything else? These are just my total gains, total losses. I just want to showcase everything so you all can see it too. Now again, I'm slowly adding to these positions. I don't want to build out some positions like Meta way too much at current prices, just because I don't want it to take over my portfolio on the off chance that something happens to it. So with that being said, the last thing I want to show you is my YTD. So I just wanted to show you where I'm at in terms of things that gains that I've realized, and losses that I've realized. So right now I'm at a realized loss of $2,100. That does not include this negative $2,000 here. The reason that this happened was because I had positions that I had gotten in due to the hype and all that from 2020 into 2021. I sold out of those positions. I've been reading a lot and just realized that doesn't need to be in my portfolio. And maybe I'll do a post-mortem on them later on once I kind of go through it. I want to write one just for myself, but maybe I'll make a video about it if anyone wants to see that. But the first position that I have in largest, and it's going to go from largest to smallest, my first position is Meta Platforms. I'm not going to go through the full-on thesis or anything like that, but I just wanted to showcase what my current holding is, the percentage of the portfolio, and just why I think it's good and some of the negatives in some of these positions. So I like Meta Platforms. I like all the products. You can see there on the right, and it's not even really everything, but they have good free cash flow. This Mark Zuckerberg is founder-led. They have a massive user base, as well as a great balance sheet. They have a fantastic balance sheet with no debt on it. The one thing is right now, short-term headwinds is really the advertising business, because again, if we go into a recession, or if we're already in one, or if businesses start pulling back spending a ton, advertising is the first thing to go, and marketing is the first thing to go. And on top of that, Apple's privacy changes hurt them a lot. And so I want to see when we start lapping Q3, Q4, we start lapping those Apple changes, what that really looks like. I'm curious because it did hurt the business. So I want to keep adding this position as it keeps going down, assuming the fundamentals don't change. But right now, 17%, I don't want to make it too big because it's going to get kind of out of hand if I let that happen. Intel Corporation, I love Intel. I mean, I love it as a product and, you know, the things that they offer, as well as I love what the business has. So I think this is a turnaround play. I love Pat Gelsinger. He's the new CEO. He's pushing them into this new foundry strategy. And really, I think it can work. I think it's going to take a lot of basically jumping towards TSMC year over year. It's going to take a lot. I'm not moonshotting it. I'm not expecting this to, you know, triple, quadruple, you know, 10x or whatever. That's not what I'm expecting. The way I look at this position is, would I rather hold cash or hold Intel? I think I'd rather hold Intel. They have a 3% dividend. The thing is that the lower margins are going to be an issue until they start this quote unquote turnaround. And that really comes with the foundries. And when the foundries come online, they're currently building them right now, and they're transitioning. But the thing is if you look at this company, the free cash flow and everything, and the margins, gross margins, and the profit margin are all going to be down because of this turnaround. So if you look at this, you need to understand the long term, where it's going, what they're planning on doing, and see the projections in their investor presentation. Now, take that all, the grain of salt. Obviously, build in your conservative estimates and all that. But if you see like free cash flow dropped off a cliff, it's because they're investing heavily into CapEx. And the thing is R&D has been a minimal spend for some reason at Intel, and that's why they've fallen behind. So it'll be interesting to see year over year how far they can get. It looks like the new 13 gen i9 has done pretty well against its predecessor on the AMD architecture, and its 12th gen on the Intel architecture. So I'm curious to see what else they can come out with, what they can do. I like everything about this company. It's just really, where's the growth and will it grow? That's the question mark right now. Dropbox, I love Dropbox. Baupost Group actually owns a position in Dropbox, which is kind of surprising. I didn't realize that before. The current holding is about $1,100, close to $1,200, about 6% of the portfolio. I really like the recurring revenue model. It's founder-led. The free cash flow is great, and it's increasing. They're estimating to get to, really the target is to get to $1 billion in free cash flow per year as of 2024. So that'll be interesting to see. Their earnings are starting to come back because they took a huge one-off loss back in 2020 due to getting rid of their property. They took like a work from home sort of technological first kind of initiative, so that really they got rid of a ton of office space, sent all their people to work from home permanently. So it'll be interesting. It's a really competitive environment. They do have a lot of good offerings, and they pair all those offerings together, but really it's a very competitive environment. And I don't expect this to like be a 10x or 100x or anything like that. I just think it's a steady grower, and I think it'll grow over the long term. JP Morgan Chase, I mean, what do you even need to really say about this company? The current holding is $1,100. You got a 6% position in this one. The dividends are around, I think it's like 3 or 4% now. They have a good balance sheet. They have one of the largest banks in the world, great management team. Jamie Dimon's obviously the CEO. The two things that I wanted to mention though is I think that with some of the headwinds that we're seeing um, in the housing market, as well as some of the other loan-driven markets, this could really lower their earnings in the short term. Obviously, as we go back, we'll probably see some better growth. But the thing is that with loans, as we're starting to see where companies are loaning things out, but you don't figure out about it until someone files bankruptcy. This is the issue with banks is they have so many loans that if their risk management isn't done well, it can become an issue because you won't figure out that a loan's gone bust until it goes bust. And there's a good chance that, I think the balance sheet's around a couple of $1 trillion for JP Morgan. If you really think the CEO knows every single loan? Probably not. So good risk management. The thing is, we haven't seen a recession in how long has it been? 2022, 2008, give or take 14 years, 12, 14 years, depending on when you calculate it from. But really, we haven't seen a recession that long. So if the risk management wasn't available or wasn't doing their job, it could be interesting. But I believe that the Fed has been working with the banks and they've all passed their stress tests. So that's a good thing. Next we got Berkshire Hathaway, obviously Warren Buffett. I got into this one pretty early into 2020. I got $1,100 position, and that's really, it's grown from the original cost basis. I think it's up like 30% from the original cost basis. It's about 5-6% of my portfolio. Obviously, good management, great balance sheet, good investment, and great subsidiaries. I mean, what can't you say about Berkshire? I'm not going to really harp on this too much, but really, it's an investment machine, it's an insurance machine, and I think they'll continue growing over the long term. It just really, for Berkshire specifically, it matters what you pay. So I would pay attention to that when you're looking into Berkshire. Corsair Gaming, this one's probably a lot more of a growth prospect. And the thing is that it was really, obviously as stimulus checks came out, it was really profitable, unsurprisingly. And the good thing is that management was smart and they took a lot of that cash that they had gotten from the stimulus, really, from people spending money from the stimulus, and they put that into paying down debt as well as refinancing their debt and trying to set their balance sheet up in better, healthy way and make sure it looks a lot better, and they've done so. So I like that. Founder led. The thing is that Corsair Gaming, as well as their other brands, are all luxury products, and it really relies on people building computers and wanting to get into building computers. And the problem is that over the last couple of years, GPU prices have been through the roof or not available at all because NVIDIA and AMD couldn't put out enough. But recently, we've been seeing GPU prices falling below the MSRP price, as well as a ton of the crypto GPUs are now coming onto the market, which is actually becoming an issue because NVIDIA wanted to originally stop their RTX 4 series cards from coming out, and TSMC said, no, we're not going to do that. We're going to keep building what you asked for. So it'll be interesting to see over the next couple of years. We see sort of a refresh cycle, and this is kind of like where the semiconductors and everything kind of meet, as well as the consumer cyclicals. So it'll be interesting to see. The thing is that computer gaming has had a rise in popularity, and I mean, like, I see people with computer games or computers, like high-end computers, all the time now. And so a lot of times once you buy one product, you're going to stick with that brand usually. I mean, you can see on the picture here on the right, you can basically outfit like your entire computer and desktop with Corsair stuff. So I like the prospect of this company. I think it's a very good esports slash high-end PC gaming specific company. Logitech's another one that I liked, but I wanted to be in more of the gaming specific and industry specific space. So it'll be interesting to see over the next couple of years how that one performs. Warner Brother Discovery, $279. It's about nearly 1.5% of my portfolio. I plan on adding to this heavily once I see the 10Q. The merger actually went through in April after their Q1 earnings, so everything from Warner Brothers is not on that 10Q if you go read their filings. So if you look at stuff, if you look at their financials or anything like that on, a website or some sort of financial website, it's not going to be bringing in the WBD financials. It's only bringing in discoveries. So I think that can cause an issue if you're not paying attention or if you're not aware. But I like the management team. They have a great content library that's already been paid for, so they can just basically double dip on this and get some great um, profit off of content that they already made and paid for. The thing is, it's a messy balance sheet. Again, they're merging two ginormous companies. And as well as it has a lot of debt. It brought in, I think it was around 43 billion, 40 billion, something like that, from the Warner Brothers bringing that in, and they paid that to AT&T. So it's a lot of debt. The management team has experience paying down debt massively like that. So we'll have to see once the 10Q and 10K and things come out for Warner Brothers Discovery. It'll be interesting to see what that really all looks like. And then obviously Discovery Plus and HBO Max are their two big platforms, direct-to-consumer platforms they're putting out right now. And it has a ton of content. They have a ton of brands. A lot of people watch their channels and watch their brands. So it'll be interesting to see. I like the opportunity. I'm waiting for the 10Q to come out so I can actually read through the updated numbers before I continue investing into this one. Because in reality, if this one goes bust and goes to zero, it's only $279 out of a $19,000 portfolio. Not a huge deal, but if I make this too big and something happens, I don't want to be the receiving end of that when if I just waited to see the financial reports, I would have known better. So that's what I'm waiting to see. I'm waiting to see their balance sheet. And then the last thing is Revolve. So I actually owned Revolve back in 2020, held it through November of 2021, looked at it and went, I think this is way too much money. And I think that this is way higher than it should be because I think it went from, I think it hit a low of March 2020 of $7. It went all the way up to almost $90 by beginning sort of mid Q4 2021. Because what happened is I think my cost basis is around like $18 and I actually sold out around 87, I think. So I almost made 300% on this, but I looked at it, I looked at the fundamentals, I was like, this does not make any sense. So I decided to sell out the entire position, and thankfully I did because it's back under $30 now. Actually, it hit $23 not too long ago, which is why I started selling puts to get back into this position. So I'm gonna come out with a full video on this and explaining the cash cover put and all that. But really, I sold puts at $15 a strike, and one's gonna expire in August 2022. The other one's gonna expire in January 2023. So I'm very, very interested in this, but I'm looking to get in at the $15, $16, $17 mark. And the reason I sold puts is because if I can get into this while getting paid to wait, this is going to be very beneficial. And again, if the stock price doesn't go below $15 or at $15 by the time these are going to expire, then I keep the $150 I got in premium, and then I can continue to sell puts because really I'm interested in getting into this position. I'm gonna have to wait to be able to get an opportunity to buy this. So I'm fine with waiting, and that's why out of the $9,000 you saw, almost $10,000 in cash that I have, 3,000 of that is tied up and waiting in this put. So if it hits, cool. If it doesn't, oh well. I'll make sure to update you either way as we keep going. But again, they have a great management team. It's founder-led. The founders own like 50% of the business or the outstanding shares. They have steady growth. They have great customer retention. But the thing is, they sell luxury products. So as people have to go back to paying off their student loans and paying back different things, what does that look like for consumer spending? My concern right now, really, in general, for cyclicals and luxury goods and all that is, what does the spend look like? Because Revolve specifically benefited from stimulus. So it'll be interesting. I don't know what's going to happen. The last thing is, what's next? What am I doing? What am I looking at? So really what I'm looking into right now, I'm looking into the semiconductor industry. I really don't want to be in cyclicals. The cyclical prices, while they're cheap, there's a lot of companies that are super cheap and on a PE basis. I don't think that the earnings are going to stay that way. And so that to me worries me. And I think that people having to pay back student loans and things like that, it's going to cause a lot of consumer spending disruption. And with the recession and inflation and all that stuff, I don't know if the cyclicals are truly priced at a low PE, or if because we're looking at, you know, the last 12 months versus today's price, it's a low PE. So I've been looking into cyclicals, as well as what I'm looking really into right now is the semiconductor industry, more specifically into the equipment space. Really, my sort of look is to try to see if I can find anything that's growing steady, maybe has a good dividend if possible. But really, what I'm looking for is something that's growing steady, buying back shares, is at a reasonable valuation. And what I've been looking at in that sort of space is Texas Instruments, KLA Corp, Teradyne, and then Applied Materials. Those have been kind of the big ones that I've been looking at. ASML really isn't at a good enough, cheap enough price, and I don't think it ever really will be. I have it on my radar. I have like a whole semiconductor list that I've been going through, but I don't think that they'll get anywhere down to like a reasonable price with a margin of safety, that kind of stuff. But with that being said, I'm going to try to see if I can sort of put together my ideas and thoughts and things as I look into things. But the two videos that I plan on doing is the Revolve puts, so explaining this, and then also explaining my thoughts on Intel, because I really like the Intel positioning and I really want to go through the semiconductor industry and the sort of the semiconductor equipment. So look out for that if that's something you're interested in. If you have any companies that you want me to look into or that you want me to, you know, showcase on the channel, please let me know down below. The goal of this, again, is all so I can learn something, you can learn something, we can keep learning together and value invest at the same exact time, and sort of just get a different idea of how to do things. So with that being said, thank you all for joining me today. I hope you enjoy my portfolio. I'll see you on the next update, and let me know if you have any questions down below. Have a great day and happy investing.